Have you ever been watching the markets and felt that a pullback looks more and more likely to happen, but you weren't sure and didn't want to risk shorting and getting run over? Worse yet, have you tried shorting and gotten run over as the price continues to climb seemingly against all odds? Well, there's a great option strategy called the bear trap. Who comes up with these great names? Which is ideal for this situation, winning big in a pullback while still providing a nice return even if the rally continues. In this video, we'll teach you the exact strategy with a real world example. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree. This is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our desk are well aware that the market is never going to go just in one direction forever, and that every rally has a pullback and every sell-off has a bounce. And so the smart traders are always prepared for those occasional reversals, and they're equipped with strategies that can capitalize on those situations, sometimes in a big way. And as you can see, the market has been on a tear since mid-March, with the S&P 500 index up nearly 600 points in that period, which is close to a 15% rally in about 4 months, which is a blistering pace. And so this is the point in a rally where traders increasingly start to consider the possibility of some kind of a pullback, but at the same time, the market is about 8% below its all-time highs, and so it's got room to run further. And then, of course, there's the old trader's adage, the trend is the trend until it's not. And so at times like these, where you could make a strong case for a pullback and a fairly strong case for continued upward momentum as well, it would be nice to have a strategy that makes good money if the inevitable pullback takes place, while at the same time having some upward runway so that if the upward move continues, we can make a small gain as well. And while that may sound impossible, that you can make money if the market goes up or down, that's not at all impossible using option strategies. And we're going to give you an example of exactly what I mean shortly. First, in order to explain how this strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll just jump right back into the details of the strategy. The best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 4,075 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market did not close below the 4,000 strike price. Okay, so with that in mind, let's see how this strategy works. So let's head back to last year, where for a different reason, traders could make a case that the upward momentum will continue, and perhaps a stronger case that the market's topping out. And that would be back on August 1st of 2022, when the SPX index seemed to be pushing the upper limits of a downward channel that it had been trading in all year. And so in early August, you could start making the argument that the index was due for a pullback, headed downward, possibly to the bottom of that channel. And so this might be a time to employ the strategy that I've been referring to. And so Let's say that on that day, the trader pulls up an options chain for the SPX index that expires about 6 weeks later in mid-September, and he goes ahead and simultaneously buys 5 of the 4,000 put options, which are located a little bit more than 100 points below where the market's trading. And at the same time, he would sell 5 of the 3950 puts and 5 of the 3900 puts as well. And then finally, buying 5 of the 3800 puts. Well, to options traders, what he's just done is to enter a strategy known as a put condor. And technically, in this case, the trade would be referred to as a broken wing put condor because the strike prices aren't exactly evenly spaced. But that's a little bit of a detail we don't need to really worry about right now in this video. Now, let's first take a look at the cash flow of the trade that we just executed. And starting with the 3950 puts we sold, those were going for 64.65. But remember, these options pay off at $100 per point below the put strike price. So you multiply that price by 100, and we sold 5 of them. So that results in a total cash inflow of $32,325. And using the similar calculation, the 3,900 puts brought in $27,025. Now, as for the 4,000 puts and the 3,800 puts that we bought, you can see that they cost us $38,550 and $18,875 respectively. And so netting it all down, you end up with a net positive cash flow of $1,925 from this trade, and your broker will require you to have at least $23,075 in your account to execute this trade at this size, which is also incidentally the trade's worst case scenario loss. Now, a little later in this video, we're going to get back to why the fact that this trade actually brought in positive cash flow is so significant. But for now, let's move to the day that this trade expires. And as you can see, the market had actually rallied further after we entered the trade, which was not the initial thesis of the trade because we thought a sell-off was imminent. And while it didn't happen immediately, it did eventually happen. And by September 16th, the day that the put condor expired, the index had sold off to 3873, which was more than 200 points below the index's value at trade entry. So because the options expired on this day, we can give each of them a settlement value now. And so after taking into consideration that we originally brought in $1,925 on trade entry, let's start with the 4,000 put. And so the way that you calculate the profit on that put is to take the put's strike price and subtract from it the closing price of the SPX the day the options expire, which, as you can see from the calculation, results in that put being 126.67 points in the money, meaning that in the case of a put, the number of points that the market closes below the strike price of the put is the amount that the put is referred to as in the money. And so we get paid $100 per point for each point below the strike price of the 4,000 put, which, because we bought 5 of them, results in a payout of $63,335. However, the 3,950 put also closed in the money by 76.67 points. And so on that one, we owe $38,335 to the owner of that put, as you can see from the calculation, because we were the ones who sold the 3,950 puts. And we also owe $13,335 to the owner of the 3,900 puts, which were 26.67 points in the money. And then finally, the 3,800 puts that we bought, well, those closed below the closing price of SPX that day. So those expired with no value, meaning that the final profit from the trade was comprised of the initial cash flow from entering the trade plus the value of the remaining options upon expiration, which, if you net it all down, results in a profit of $13,590, which comes to a return of over 58% against the original capital requirement of $23,075. But there's something important that you might not have realized, because the market did indeed sell off, and it did what we thought, and the trade really worked out well. But suppose that the market hadn't sold off, that we were wrong, and the market just continued rallying. How would the trade have turned out? Well, let's think about that. You see, the put condor was comprised of 4 options, right? 5 long puts at 4,000, 5 short puts at 3,950, 5 short puts at 3,900, and 5 long puts at 3,800. So if the market had rallied after we put the trade on, then all 4 put options would have expired with no value because all 4 options would have been at locations below the closing price of SPX on the day the trade started. And so if the index had rallied, the put options would have expired even farther below the index's closing price, meaning all of the options would have expired worthless in that case. In fact, at any price at or above 4,000, the result would have been the same. All 4 options will expire worthless, and you just pocket that original $1,925 that you get originally for selling the trade. In other words, even if our initial premise had been outright wrong, the trade makes a modest profit anyway. And so what I'd like you to take away from today's video is that with options, you can create a trade that will make money in lots of different kinds of outcomes. That's because with option strategies, you can get very creative and create these huge zones over which a trade will make money. In the example that we just shared with you in today's video, even if we'd been outright wrong on the direction of the market, we would have made some money on the trade. There really aren't any other trading styles where you can be wrong about your directional bias on the stock or index you're trading and still make money. That's why people fall in love with options trading strategies. And in future videos, we'll be covering lots of other strategies that have similar characteristics and give you a chance to make money in so many different ways once you're trained to understand how option strategies work.
Okay, if you like this strategy, you'll love the 0 DTE option strategy, which gives you the potential to capture super quick returns. Just click the video appearing on your screen right now. You don't want to miss this awesome trading video to help you grow your trading account.